So welcome to today's webinar. Thanks for joining us today. This is part two. Hopefully, if you haven't watched the first webinar, I highly encourage you to go back and listen to the wisdom from my guest, Bruce Wehner, who's joining me again today to kind of go part two in this, right? Because the infinite banking concept, we gave you some core elements of the concept and process. Certainly gives you enough information, hopefully, to give you a sense of what it is. But just as always happens when we share this new concept with folks, they have questions. And so today what we're going to cover are some of the more common questions you hear about IBC and the infinite banking concept. And thankfully I'm here with my good friend Bruce Wehner, and thankfully I've been able to have a conference here in St. Louis and do this face to face. So Bruce, thanks for joining me on this webinar today.
Oh, sure, Tom. These kind of questions come up all the time, so I think it's going to be very helpful for us just to take the questions that we always get and have them in one central located place that people can just run through.
No, that's great. That's great. And with the idea of we're trying to just educate you on this process to see if it's right for you, and then obviously go seek out the right types of advisors to help you with them. So, when I often get this question, Bruce, especially when people start learning about it and see how powerful it can be. So why isn't everyone doing this? Why haven't I heard this before?
Yeah, so I answer this two different ways. First of all, I have a colleague who says, well, the reason everybody isn't doing it is because I haven't talked to everybody. Because if you talk to people and they're like, oh, yeah, this makes sense. But I think we've been indoctrinated. I'm of the generation, of the baby boom generation, and that was kind of the stock market's been around for 100 plus years, but the normal individual did not have access to the stock market. And then in 1979, when the 401k came around, where every individual, if you had a job and they offered the 401k, you could buy stocks, and so people were just taking their excess money and putting it in stocks. It was very easy, and storing money in whole life insurance just kind of fell out of vogue, and so a lot of people, it wasn't at the top of their mind. And then you couple that with the fact that life insurance companies, especially mutual life insurance companies, they are very conservative and they want to pay a dividend. They don't have a lot of expenses as far as advertising. And so when you don't advertise to the general public, there's only two mutual life insurance companies that I can think of that actually do a lot of advertising: Northwestern Mutual and Mass Mutual. But frankly, I don't think they're doing it for their life insurance. They're doing it for their other financial services, which is kind of ironic when you think about it. So why isn't everybody doing it? I think it's just because of the conservative nature of insurance, and then also it's kind of fallen out of vogue because it is something that you have to be presented. Somebody has to present it to you. I wouldn't say it's complicated. I think people make it complicated, but we've just said, oh, I'm going to get in the stock market just take it out of my paycheck, 401k, put it in there. So that's why not everybody's doing it. But I think as it's becoming, the social media has bringing it back to the forefront. And I think that's why people ask this question so
Yeah,
often.
no, it's great. And, we can easily get so caught up in it. And we even sort of talked about in the original webinar, the difference between saving and investing. Mm-hmm. Right, when you're putting money and taking the company match or whatever, putting to your 401k, you are investing that money. That is at risk. It's subject to loss, and we know some of the other, negatives around that money that can't be used easily throughout life until later, way later in life. So, it's I think there's a combination of those types of things, and we just get so ingrained that putting money in 401k is saving money.
Right.
It's actually investing. This is a very different process. So that's great. With that same idea, which I find it is funny, like I haven't talked to everyone, and certainly I haven't either, so people haven't seen it. But would you say infinite banking is for everybody? Is it suitable for everyone?
Well, I would answer like this. Does everybody use a bank? And I think most people use a bank. There are some people that don't use banks, usually because they don't have a lot of cash.
Yeah.
And they don't have a lot of transactions and they work with cash. But if you use the bank, the infinite banking process is actually using a different institution for your saving and borrowing needs. It's not for your everyday transactions.
Yeah.
It's not for your writing checks. It's not for using a credit card and paying off a credit card. It's not for your everyday transactions. But if you're looking for a rock solid place to save money, and the Austrians love it. The Austrian economists love it because insurance companies cannot inflate the money supply. And so a lot of people think, well, I'm just one person. Can I really help get inflation under control and so on and so forth? Well, maybe not one person can, but if you really don't like the way the country's going with this inflationary situation, well, you frankly can blame the government that allows the printing of money, and the Federal Reserve is not federal. It is owned by the 7 commercial banks in the United States. However, the only way they can print the money is if the federal government promised to pay those bonds back. That's the only way they can do it. So I think people, if you're really wondering, is this for me? Well, number one, you have to be a saver. Okay, you have to be disciplined. If you're not disciplined, then I wouldn't do it. I frankly wouldn't. If you're worried about the banking process, now let's just talk about the banking process. The saving of money in the bank, actually, when you do make money on it, it's called interest, and you're actually paying taxes on the interest. Then, if you want to get a loan from the bank, you have to fill out all the application and so on and so forth, and hopefully they give you the loan. When you store money in a insurance company, it's just another financial institution that you're storing money in. They're going to give you interest and dividends, and the tax code 7702 says interest and dividends that are done correctly inside an insurance contract are not taxable. So even though maybe the returns, it's not always like this, but maybe there's times when the returns are less. If you do what they call the taxable equivalent, then they actually are comparable or even better than storing your money in the bank. And then the final one, which I think is the most important one that people really like about this, is per contract at the insurance company, they must allow you to take loans from their reserves, and they use your cash value as collateral for those loans. And because they already have the greatest collateral available, which is actually cash, then they're happy to give you the loan, because if you don't pay them back, they already have the collateral. They just shift it from one column to another column, from a liability to an asset. So they love it. And so I would just say that to sum this up, if you're not disciplined and you think, oh, this is just a free money, I don't have to pay the loan back. By contract, you don't have to pay the loan back, but if you don't continue to do that, you're not going to have that capital for the future.
Yeah, no, that's great. Yeah, I agree with you. It isn't going to, which I've heard some folks use it. Hey, this is the way I'm just going to try to get rid of all my debt.
Right.
If you're not responsible with that, with the management of debt and cash flow, this is not going to just automatically solve it, right? You still have to have those good habits financially, and that's, to me, is a better fit. And sometimes we have to get people on a better track before they can even start, right? So they can get to those right financial habits that are going to withstand the test of time and help you build your wealth.
I would say that there's some debt that some people, it's a one-time occurrence. So example, they may have a catastrophic health situation. Yeah. And so that's not the debt we're talking about. We're talking about people that are constantly undisciplined, using credit cards, getting a big car payment well above their means, so on and so forth. What I found when people are trying to get out of that debt, what they end up doing is they try it for a while, and then they fall into their bad habits. So now they still get the debt, and they have a premium payment with the life insurance company. And then they say, see, I said this wouldn't work, and I was right. And I'm like, well, that's because you're not doing it properly. That's why it doesn't work.
Right. So with that, I mean, and maybe that hits on it too, like some of the maybe risks or drawbacks of the infant banking concept. Just like anything, we try to be fair and balanced, Like, how would you describe it?
Well, I think the biggest risk is early liquidity risk. And I always tell people, whenever you put your money anywhere, you're looking for safety, liquidity, and growth. Those are three things that you're looking for: safety, liquidity, and growth. And you can't get all three of those in one place to put your money. So I'm just going to give a couple examples. So if you put your money into a regular bank, commercial bank, you're going to have safety, you're going to have liquidity, but you're not going to have much growth. If you're going to put in the stock market, you're not going to have safety. You are going to have liquidity because you can sell it the next day. And traditionally you have growth, but there's going to be time periods where you're not going to have growth. If you put it into real estate, it's not safe. We found that out in 2008. It's not liquid because you actually have to get permission from the bank to use your real estate as collateral and then give the money back to you. Now, traditionally it has grown, so over that time period. Well, when you're actually looking at life insurance as a way to take care of your banking process, it's probably the safest asset that you can actually have. Some people would say gold, but I would say gold actually can go down. I own silver, and I've lost money with my silver. So it's a hedge against inflation. I would say commodities are like gold and silver, but I wouldn't say it's safe. Insurance companies actually have to have more in reserve than they've actually have promised into the future. Where a commercial bank only has to have minimum 10% of what they have in a bank, and they can actually inflate the money supply. So I think it's the safest place you can actually have money. But in exchange for that, it is an insurance product. So early on, you're setting up your own little business. I've made this comment to people all the time on our podcast, is that, think about a business. Would you take, several tens of thousands or several hundreds of thousands or several millions of dollars to start a business and expect the next day you're going to make the same amount that you just put into the business? No, everybody knows it's going to take time to grow the business and so on and so forth. And so this is what happens, even though it's specially designed and we're actually trying to improve the liquidity, there's always going to be some lack of liquidity in the first 4 or 5 years. You're not going to get the entire amount, but that's actually good. We call that in the industry, not the life insurance industry, but the financial services industry, you need to get a liquidity premium for people to do that. Now, what do I mean by that? Well, think about a CD at a bank. The longer you take a CD term out, the more you expect that you're going to get paid for that. If you go into private equity or private placement or private lending, you're going to say, hey, if you're going to have my money for a long period of time, I better get a bigger rate of return. So now let's take that to life insurance. So there are some designs out there that people say, oh, we're going to pull down the base to be very small. We're going to be high PUA, so we're going to have a lot of liquidity early. Well, the exchange for that is you're going to have lower dividends. And it also brings in risk in that situation. If you build it up higher, yes, you're not going to have as much liquidity, but you're in line for bigger dividends, and you've really lessened the risk. So if you think about safety, liquidity, and growth, when you're talking about risk, I think that is something that a person needs to keep in mind. It's no different than any other asset class.
Yeah, no, that's a great way to put it, and that's where with IBC is the importance of thinking long term about things. Right? If you're thinking very short windows of time in here, obviously you can easily say, oh, I don't have all access to all my money that I put in there in the first couple of years. Well, because you haven't understood the broader scope of this strategy, right, and why we're doing this and the purpose. It is a long-term strategy. So definitely going back to the other thought of people where this is not a good fit for, they're very short-term thinking. This is not the right spot, especially if you're going to use that money for something very short-term, like buying a house or something, or some sort of investment in a vehicle. Like maybe that's a secondary piece. You put the money you earn from that into your policy.
Correct.
Right?
The cash flow out of that.
Right, the cash flow out of that. So it's just having that long-term lens. So another question, because obviously there are, putting money into a bank is easy. I go set up an account and just dump it in, and I have to qualify for it. So, setting up an IBC sort of system takes a little time and such. So walk us through like kind of some of the core things.
That's interesting. That's interesting. On our podcast, people write comments all the time, and one of the comments a guy wrote on there, and it was a male. You could tell from his name and his picture. He said, this isn't good because when I go to my bank, I can just put the money in my bank. I don't have to ask anybody for permission whether I put my money in my bank. Well, you actually have to ask permission because you do have to fill out an account statement, and you have to go through anti-money laundering, training and so on and so forth. But once again, when you have to go through something, you want to get something for that. So what you're doing is you're actually setting up a life insurance policy. Now, it doesn't have to just be on you. It could be on somebody you have an insurable interest of, a spouse, a child, a business partner, so on and so forth. So you really have to go through a application. So there's going to be some health questions that they're going to ask, and then that will actually go to the company. If the company doesn't think there's any problems with it, by the way, it's not just health. They're actually going to ask about your finances because they want to know the health of your finances, frankly. And people often are confused by that because they say, well, why do they have to know about my finances? Well, first of all, they don't want you to be worth more dead than you are alive, okay? Because there can be some nefarious things that go on there. The second thing is, believe it or not, they want you to be successful. And why do they want you to be successful? Because insurance companies want people to continue to actually set up these policies. And so they don't want to stretch you out. Everything they ask you financially is for a reason for your success. So they're going to ask you health questionnaires, they're going to ask you financial questionnaires. And then that's going to go to the life insurance company. The life insurance underwriter who specializes in charts that says, okay, for this age of a person, whether they're male and female, they have these kind of health, these kind of habits, their mortality is going to be to X in general. So then they can price that out. And what happens then is, if that is a good risk just like that, then we're good. They're just going to make an offer. But if they see something and they're wondering about it, they're going to then actually request additional information. Now, what is that additional information? It's called an attending physician statement, or APS. And that attending physician statement simply goes to your doctor, and they will send the charts to the underwriter. They're also going to do a prescription drug test. They're going to do a soft credit check, and they're going to check out your driving record, because obviously prescription drugs are going to tell about your health. They're going to talk about your soft credit check, because they found there's a correlation from stress and how people live their lives more dangerously if they don't pay attention to their credit. And then their driving record, I think that's obvious. I mean, if you have a DUI or a bunch of reckless driving or tickets or so on and so forth, those people tend to die faster than the normal population. So they'll check all of those out, and then they'll make an offer. None of this costs you anything. Well, I joke around all the time, it might cost you a little blood or urine because there are times when they will do that, but you're not obligated. And it's the cost of doing business by the insurance company. Just like anything, the cost of doing business. Like you walk into a local convenience store and it's got air conditioning in there. They don't charge you for the air conditioning when you walk in, but it's because that's part of the cost of doing business. Well, it's the cost of doing business for the life insurance company is to go take you through all this on their dime. Then they may, if it's a high enough death benefit, they may, and there's something on your health questionnaire, they may actually send a nurse out to verify what you told them, and to take some height and some weight measurements and draw some blood or some urine. And then finally, they'll make an offer. And that offer, people get really bent out of shape about this because people think they're healthy and they'll maybe only get a standard rating. And they think, I'm not average, I'm healthier than average. And I tell people, well, remember, it's a bell curve. Okay, so most of the standard is the meat and potatoes of the bell curve. And also is it's not about everybody in the population. It's about people that can actually qualify for life insurance. So they're already eliminating everybody that's not on the bell curve. They're already eliminating those people, and they're declining them. Then they're going to have either preferred or super preferred on this end, and then they're going to have what's called rated policies on this end. Rated means they're going to charge you a little bit more for each rating for the actual life insurance. It doesn't mean it's not going to work, because if you still design it properly, you'll still have good cash flow early. You'll just have less death benefit. On the other side, the cash isn't going to accumulate at a high rate just because you have a preferred or super preferred rating. You're just going to get more death benefit. So that's basically how the process goes. And then once that they've said they're going to give you a rating, you can accept it just like it is, or you can modify it. What I mean by that is, let's say you said, I'm going to put $50,000 a year into this particular contract. And then after you got to thinking about it, you're like, I really understand this now. I'd like to put $75,000 a year. Well, you can modify it at that time, but now it has to go back to the underwriter. And he or she has to look at it and say, well, you were a really good risk at 50. I want to check out and make sure we're not extending ourselves too much for 75. However, if you go on the other end and you say, 50 is good, but let's just start it with like 40,000. Well, if you're a good risk at 50,000, you're even a greater risk at 40,000. So that's a really easy one. They just say, okay, we'll modify it down at 40,000. They can literally do it in the same day. So that's how that whole process works. Then you actually work with somebody in our offices, and they will actually work with you paying either monthly, quarterly, semi-annually, or annually. The most efficient way to get your money working for you is annually. That's because the insurance company has your money right away. You're not trickling it to them throughout the year. And because of that, you're going to get a return on your money faster. The other thing is, if you go to semi-annual, quarterly, or monthly, there's actually more administrative work. And the insurance companies actually pass that on as the cost of doing business to you. Because they're like, that's not fair that you're paying monthly and another customer's paying annually. You're going to have to make up the difference of that. So they're going to charge you a fee with that to do it monthly. They're going to charge you a little bit of a fee to do it quarterly, and then even a little bit of a less of a fee to do it semi-annually. And then you just set it up, and you can do it by ETF or EFT, EFT, electronic funds transfer. It just comes out of your checking account every month if you do it monthly, or you can do a one-time EFT. And it's a very easy process.
Yeah, no, it is, and you went really, it's a thorough explanation of it, and there's a lot of parts to it, but the companies are taking a risk with the clients that maybe are eligible for it, so they have to take some time to evaluate it, right? It's not just a simple process like we're talking about banks, because this one you're evaluating their life and their risk, and so they have to go through some of this, especially if you're going to higher numbers.
I always tell people, it's not a good deal for the insurance company. If you give them $10,000 one day, and 2 days later you die and they hand your beneficiary $500,000, that's not good, okay? And so they're going to try to minimize that whenever possible. Now, because you have to go through that process, once again, what's the premium you're getting for it? Well, you're getting uninterrupted compounding. You're getting tax-free interest and dividends if it's set up right, and you're getting a heck of a death benefit to protect your family or do generational legacy planning for it. So you got to get some kind of premium if they're going to put you through a process. Yep. Bank doesn't put you through the process. They just say, here, fill out this account form, give me your $10,000, we'll put it into the bank. Then why do they have to entice you to do, or give you anything for it? They don't have to because it's easy.
Yeah, well, definitely, if you ask them for a loan, they're gonna go through this
Right.
process very deeply.
Because they're worried about
Right,
losing that
because
money.
they're worried about the risk associated with that, so
Right.
it's kind of equatable. Now, that's great. Yeah, and on the kind of a secondary piece to that, even after getting it set up, and this is kind of a key thing as it evolves over time, the importance of having great advisors to continually work with you over the course of the years as you own this type of policy and system, right? To work with you to make sure that it's being properly managed and kind of give you an idea of different options depending on what's happening in your life. So having that consistent advisor is so key because it is not just set it and forget it, right? This is a constant thing. This is going to be a function that you're going to be using in a whole host of ways depending on what's going on, and having advisors with you to help you make the better decisions around this is very key in my mind. So obviously with IBC there is the concept of leveraging the cash, right, for other purposes. So that involves taking a loan from the life insurance company to do so while your money and your cash value continues to compound. And that's really part of the kind of secret sauce, if you want to call it that, right? But it's how it works, and there's nothing magical to it. You hear some of these things like you pay yourself interest to yourself, which is not accurate, right? So how does the loan and interest sort of process work with the life insurance company?
Yeah, I think the best way to explain this is to first use an example that people understand. So if most people either own a home or they know people that own homes, and they've heard that you could actually set up a home equity line of credit. And so when you set up a home equity line of credit with a bank, they actually ask you a bunch of financial questions, and they actually set your house up as collateral in case you don't pay them back. But they actually do not give you total liquidity, 100% of the equity that's in your home, because if you don't pay them back, the bank doesn't want to be in the business of selling your home. One, you can actually trash the home, make it less valuable. That wouldn't be good. Two, we could have an economic downturn. Three, they have to actually pay somebody to sell the home. There's a lot of transactional costs into that thing. But if they do set up a home equity line of credit, then you can actually write checks or have a little debit card to your home equity line of credit. And you don't, but the difference is the bank actually puts you on a repayment schedule. Now, it can be interest only. But they're going to put you on a repayment schedule. Why? Because they don't want to take the home back. They don't want to take the home back because of all the things I've already said. They don't want to be a real estate manager. So that is how most people understand how loans work. With a life insurance loan, it's very simple. The life insurance company already has your cash, and they're going to use it as collateral. So all you have to do is literally sign one piece of paper with your signature, and then they will EFT, electronic funds transfer, from the cash reserves of the insurance company to your bank. Now, the life insurance companies tell us, because we work with several life insurance companies, they tell us, tell your clients it'll take 3 to 5 days. But once you get it set up, you can get it in 48 hours. I'm not promising that, but I'm telling you that it's that quick. You can't get a loan like that from a bank for your real estate. It's absolutely impossible. So then what you do is you set up, and this is where Tom was just talking about having an advisor, you want to set up a repayment schedule. Now, even though there's no contractual reason in the contract that you have to set up a repayment schedule, it makes the most sense because you need to be an honest banker, because you're replenishing your capital so that you can use it into the future. Now, what Tom was also mentioning about people saying, well, you're paying interest to yourself. You're literally paying interest to the insurance company. So the insurance company is going to charge you an interest rate because they're using reserve capital from their reserves, their capital reserves, and they could be using that to invest in other bonds, real estate projects, even some securities. And so they have to make money. Why do they have to make money? Well, they have to run the company, and they have said we are going to, any profits we're going to pay back to the policyholders in the form of a dividend. So just like any business, they want to show their policyholders, hey, we're really good at running the business, and this is why you should give us money, because we're going to pay you a tax-free dividend coming back. So that's how the policy loan works. The great thing is there's flexibility. So let's say you take out a $30,000 loan, you go buy an automobile, and you start paying $500 a month. And then all of a sudden you lose your job, or your spouse loses your job, or some other thing comes up financially, and you're like, I can't make $500 payment anymore. I'm only going to make a $400 payment. Or I don't want to make a payment for the next couple months till I get caught up. Try to do that with any other loan at the bank, and they're going to say you're in default. Okay, so there's a lot of advantages to this. Now, as far as paying interest to yourself, you could say indirectly, because you are a part owner of the life insurance company, the dividend is actually part of the interest payments back to the bank. So you're getting some of those dividends, and they're larger because the insurance company's making money on the interest payments. Now, Nelson Nash said, hey, if this is just more money that you're accumulating in your own banking system, and if the insurance company's charging you 5%, why don't you charge yourself another 5%? Technically, though, it's not interest, and in Nelson's book, he actually talks about this. It's actually you're buying more paid up additional insurance, which we're not going to talk about, I believe, in this frequently asked, because it was in the last webinar. But you're actually just buying more paid up insurance. And actually that's more valuable, because the more paid up insurance you actually buy, the higher the death benefit, then the higher the actual dividend. So everybody wins in this situation.
No, that's great. That's a great explanation. Yeah, and it's just you hear a lot of miscommunications around this. And you are actually taking a loan, right, from another financial institution, just a life insurance company. So you have to be responsible, but you just have flexibility with it, right? Just given the design of the policy loans. So maybe related to this too, which we often hear, and we talked about this a little bit earlier, around potentially using IBC in this process to help pay off debt, right? Other debt you have. Let's call it a mortgage, for instance, right? A common thing people will have. So can this process be used to help pay off that debt?
Yeah, absolutely. It absolutely can. I just want people to realize that the reason people want to do it like this, they say, okay, if I just take any excess money I have every month and I start paying off my debt, then that money's gone forever. And when that money's gone forever, we call that, we lost some opportunity costs. In other words, we can't make money on that anymore. So there's a lot of people out there that say, well, with a properly designed life insurance contract set up for infinite banking concept, if you put the money in the policy first, it's going to, for the rest of your life, as long as you have the policy actually intact, it's going to continue to compound. So that way you don't lose the opportunity cost. And then you can actually borrow against it and then pay off the debt. I'm not against that. I'm just saying that you have to look deep into your soul and say, am I going to recreate the debt? And that's what I was saying earlier, some people, they have a medical debt, or maybe they have a debt such as something catastrophic happens in their house. I've had to pay $10,000 just a couple months ago for my new air conditioning system. And luckily I just had the cash value and I paid it. But if not, somebody may have had to take a loan out and went into debt, and they're like, well, now I'm paying that off and I'm losing all that compounding that I could do. If that's truly what happens to people, then I think it could work. But if it's somebody that's run up, $2,000 furniture loan debt, $15,000. I just heard today, Tom, that the average American right now, we're recording this in June of 2024. The average American right now, per American, has $15,500 of credit card debt. So, and there's a lot of reasons. I mean, I'm not blaming people for this because inflation is just rampant right now. But you have to say to yourself, are you just going to recreate that debt? And are you going to pay it off and then just get into good money habits? Build up cash before you spend it. Build up cash before you spend it. Something our government maybe should do, you know. Because I tell people all the time, if you have $15,000 of credit card debt and it's cost you $300 or $400 of interest every month, then that's, you know, that's $400. That's close to $5,000 that you're paying to a financial institution, a bank, by the way, that you don't get any more benefit from it. You could have used that to enhance your life or save for the future. Our government's doing the same thing right now because we're making interest payments to pay off, to not pay down our national debt. Well, all we're doing is paying the interest. Well, that extra interest payment could actually go to fund things that can make the citizens of the United States better, lives better, roads, infrastructure, services, so on and so forth. So if you don't like the way the government's running their lives, you need to look at your own life and figure out, hey, I don't want to do that.
No, that makes perfect sense, and that's why a lot of these sort of situations really have to look at your specific situation, and kind of to your point around if you're carrying lots of debt and it was due to some mishaps or maybe potentially habits you want to maybe reevaluate, then maybe this isn't the best approach to start IBC yet until you can get that settled first and get onto a better stream. So it's all going to depend, but you know, again, this is why you work with a IBC practitioner to help you evaluate when is a good time or what might you need to do before you get started, especially if it relates to debt. So maybe this is somewhat related because, you know, we think about loans and taking out mortgage or, you know, buying something, getting like an SBA loan to start a business, other things. There's a purpose to them. Like, what are the things that people can use policy loans for?
I think if you follow Nelson's examples in his book, one of the greatest example he uses is cars, because everybody, well, you know, maybe I shouldn't use an absolute. Not everybody has a car, but most people have a car, and they understand this. And so Nelson was saying that every time you're paying interest for that car loan, that's money that's flowing out of your control, and you don't get a return on it. And so he showed an example. His wife's name was Mary, and he used to say, Mary's getting a car after 4 years, no matter if she wants one or not. Because Nelson figured out the perfect sweet spot was to buy a car outright with cash from the dealership. He would then use a policy loan. He would pay the interest to the insurance company, and then he would pay more to build up his cash value. And then after 4 years, he'd have the policy paid back, he'd have the depreciation of the car, and then he would trade the car in, plus the increased cash value, and Mary would get a nicer, newer car. And he just kept rinsing and repeating that. And so that's the classic example I think a lot of people can relate to. Nelson also said that he eventually paid off all of his real estate loans. And that takes a longer time, okay? People get overwhelmed about how they could do this, and it's the old saying, you know, how do you eat an elephant? One bite at a time. You just work on it, chip at it, so on and so forth. So you can use it for, like I said, I use it for my air conditioning that went out. I've used it to invest in different things. And then I use the cash flow from the investment and I pay back my loans. You could use it for college. It's very popular for college because you could actually take it out on your own children. You could be the owner and then use it for college expenses. And then when they're out of college, you can actually change the ownership to your child, and they can take over making the premium payments and paying back they can pay back their college loans.
Yep.
By paying back the loans in their own cash value. And now they have more cash to start their lives out. So Nelson once told me, he goes, I called it the infinite banking concept because there's an infinite ways you can use it. He said that the only The only thing that holds you back is your lack of imagination. So,
Yeah,
that's
no,
that's what you're using.
no, it's great, and you know, and I think you talked about before in terms of it's not probably best used for maybe basic transactions that you're doing every day and
Right.
you know stuff to live. It's
Right.
not as liquid and sort of flexible as like a bank account, right?
And-
in that respect.
Yeah, and it's also complicated, and if it gets complicated, you're not gonna do it.
Right, no, and that's just not gonna happen. So the reality is there are probably things you wouldn't use it for, but there's still, like, as you said, tons of ways to leverage this as if you're using your bank, right, or a bank institution for. So you can imagine there's tons of things. Certainly use it for big expenses and then certainly investments that flow back into our bank, just like you would normally do. So, great stuff. So and we talked about before a little bit about dividends and, so how do they work and how do we use them? Like what? Because we know we're used to seeing that maybe with our stock portfolios. You get dividends. So what is this? What's this dividends look like for whole life insurance?
Yeah, so I tell people all the time is dividends are excess profit. In a mutual company for life insurance, they're technically classified as excess premium. And people get bent out of shape all the time. They say, well, see, the insurance company's just charging you too much and they're just returning your money. Well, I can easily prove that's not the way it works because you can pay so much in premium and have it paid up in 7 years or 10 years or 15 years. And so your cumulative premium, if all they're doing is returning your premium, then you wouldn't have cash value that's greater than your premium. And, I mean, we just got to use a little logic here.
Yeah.
But that's the way the IRS actually classifies them so that they can be tax-free, return of premium. But it's no different, and I've said this, and I think people relate to this. Coca-Cola, UPS, they declare a dividend. A lot of these stock companies declare a dividend. Well, that's excess profit. So what they're saying is, we charged you too much for that Coke, and we're returning some of that price of that Coke to you, the stockholder. And so it's the same thing as what people say it's just a return of premium. Well, they charge you too much for the Coke. So they overcharge you for the Coke. It's the same thing. The difference in the dividend, I think if we can run through this real quickly, is how they calculate the dividend is proprietary. Just like Coca-Cola's board of directors is not going to tell you how they came about, how much per share they're going to give you as far as a dividend. But let's just go through this. What are the expenses of the company? Well, the expenses of the company are the home office, real estate expense. They have the service expense of all the personnel that work at the home office. Those personnel will include an actuary that designs the contract, an underwriter that you need to make sure that people aren't going to die prematurely. You're going to have executives that run the whole company. And so those are the home office expenses. Then they're going to have a sales force, and that sales force is going to get paid a commission to actually present and service these particular policies. Then they're going to compare that to the revenue that they bring in. Well, where do they get the revenue? The premium comes in, and then the life insurance companies, because they're making promises that that money's going to be there, they actually invest it in conservative places. What kind of places? Treasury bills, treasury bonds, corporate bonds, real estate, private lending. They do a slight bit of securities, maybe 3 or 5%, and then they will also do a little bit in hedging in derivatives, where they're basically taking options to do this. But those last two will make up a very small percentage of it. Then they'll figure out how much the CFO, the Chief Financial Officer, will figure out how much did they make this year off of that, how much did they spend, then they'll have a profit. They don't distribute the entire profit. They'll take some of the profit, they'll put it into the reserves of the company, and then they will take the rest of the profit and they will declare a dividend crediting rate. And I'm just going to make up a crediting rate. They're going to declare 5.5%. I want everybody listening to this webinar to listen to what I'm about to say. You cannot multiply your cash value by 5.5%, and that's how much it's going to grow. Your cash value is not money. It's actually just tells you how much your surrender would be if you were to give up, and then they would turn it into money. The dividend crediting is for the entire pool of money that they're going to give out. Younger people will actually get a higher percentage. Younger people will get a lower percentage because when they get their dividend, they are going to actually be able to compound that until the endowment age of what we call in the contract, age 121. Now, I know this sounds ridiculous to a lot of people because they say, well, what is it that means? It means at age 121, the cash value and the death benefit must, by contract, must equal. And they will just write you a check. Here, Tom, here's a check for your death benefit if you're still alive at 121. Now, people think that's ridiculous, but these contracts used to go up to age 100. And so many people were living to age 100 that the life insurance companies pushed it further out. So that's what happens to a 10-year-old. Now let's compare it to a 65-year-old. If the 65-year-old was getting the same amount, they would never catch at age 121 because they don't have as many years to catch up. So a 65-year-old actually gets a higher percentage of the dividend credited to their cash value. And so if you're watching this on the webinar right now, the 10 years old curve would be flat and then take off, where the 65-year-old has to take off to meet at 121. I once said this in a podcast. I said the cash value at any time in a person's life is the net present value of a future death benefit, because they know it has to meet the future death benefit. And I got an engineer at a nuclear plant in Louisiana said, he was listening to our podcast and said, the light bulb came on when I, of course, engineers are math nerds, but finally he understood how the dividend crediting worked, because he said, oh yeah, that means that cash value, it has to catch that. So at a 10-year-old, you actually have to give them give them less. I keep saying the wrong thing. Give them less because they have more time to get there. A 65-year-old doesn't have as much time, so his cash value has to grow faster. And I think that's a perfect segue for one of our next questions.
Yeah, so the other part of it too, and one other thing I just wanted to add with dividends, and I know you share this a lot, and I think it's really important for folks to understand, especially around you might hear these skinny base sort of policies versus, the base portion of the policies is so key, because over the long period, if you're thinking about this long term, that's really is going to help drive significant dividends over a course of time, right? So, this is a trade-off, right? People who want these skinnier, smaller base policies and large PUAs that they can access, well, long run, there's going to be an impact around the dividends, right? Having that strong base is going to ensure that you have good dividends, larger dividends over a course of time. And so you just want to factor it in if you're thinking about long term.
Very good.
So one of the things too, which some people I don't think have really thought about, because I've never really introduced to it, is the types of companies. Right? Because it's not like every company is suitable for IBC. And so, there's stock companies, mutual companies. So, what's this all about first?
Yeah, we often get people say, "Well, I already have life insurance. Can we just use this?" Somebody sold me a term policy, which term policies are great. I mean, it's great protection, but they'll have conversion features that you can convert it to a permanent policy. And I'll say, yeah, but the problem is that's a stock company. Where do the profits go for a stock company? They actually go to the stockholders. Okay, they don't go to the policyholder. You can have a stock company such as Lincoln Financial Group, and you could actually be a stockholder without actually having a life insurance policy from Lincoln Financial Group. Well, with a mutual company, the only way you can actually benefit from the profits of a mutual company is you're a policyholder, because all the policyholders are part owners of the mutual company. So the difference between having a stock company, I'm not saying that you shouldn't have life insurance with a stock company, but you can't do the infinite banking concept with it, because you're not going to receive the dividends or the profits from a stock company. They go to the stockholders. So you really want to have a mutual company, and mutual companies, there's not a lot of them around anymore. There's maybe only a couple dozen, and of those couple of dozen, there's only maybe dozen of them that are strong enough, in my opinion, to actually do this concept. And what I mean by that, they're not going to go away. They're not going to go away. The industry is really good at taking care of each other. And by the way, they also have guarantees by the state. They're going to guarantee the cash value of the companies, just like FDIC guarantees up to a certain amount in a bank. But the stock company the mutual company could demutualize and become a stock company. And that happened a lot when, in the 90s, when interest rates went way down. So there's only about a dozen good mutual companies around that are really good for this particular concept.
Yeah, and the ones we use are all highly rated,
Yes,
well established, been around for well over 100 years for a lot of them. So they're steady and well capitalized and large, and they're using Condex scores and everything. They get rated and evaluated. So only using those highly rated ones are the ones that we focus on. So the last to kind of close out this session, there's so much great information here. And I hear this often from folks. Once I finally get it, I wish I started
Right.
years ago, right? Am I already too old for this? Can I even benefit from that? So, what are your thoughts around that, Bruce?
Yeah, I tell them, I don't have that problem, because my dad took one out on me 60 plus years ago when I was born. And so I tell people I was doing the infinite banking process before it was even cool to do it. But yes, starting earlier doesn't mean because a lot of people say that, Tom, because they think, well, I'm too old for life insurance.
Right.
Okay? But you're actually building up cash value faster from what we were talking about earlier, the net present value of a future death benefit. You just don't get as much death benefit. That's the biggest change between starting earlier, like in your 30s, and starting at 65. Heck, I did one of my father when he was 71 years old. I've done a couple of 74-year-olds. And, the companies will do it all the way up to age 80. But I think anything past 75, you really have to be in superior health. You have to have reasons that you really want to do it, because the cash value does grow, but there's going to be a time where there's going to be a drag on the death benefit. But I would say definitely up to age 70, it's kind of a no-brainer. From 70 to 75, you got to look at the health of the person. And then from 76 to 80, you really got to have specific reasons why you want to do it to see if it's going to be good for you and your family. So that is the actual reason why age doesn't play a big part of it, because you're simply pulling the death benefit down for an older person, but you're actually, the cash value grows even better than it does for a young person.
Yeah, because to that point, especially if you're designing it the way we're designing, the cash is going to go faster, right? You're going to have access to, even though there's still that a little lack of liquidity early on, it's going to speed up based on these designs. And to your point of view, as long as you're of decent health, it still definitely can work, right? Obviously, starting earlier, and that's why, there are philosophies around this to start when someone is born, to put a polish on, because they have the longest window of time, right, to get that done. But obviously we want to have policies on the parents first, for sure, to get that started. So those are, hopefully, we covered a ton of ground on this webinar, and these are just some of the top 10 we kind of selected, and obviously there's probably others, but hopefully this gives you a lot of great information to help you think about kind of and demystify some of the things you may have heard around IBC and whole life insurance as a whole. And certainly if you have more questions, certainly post them into the comments or reach out to Bruce and I so we can help answer these questions for you, because the more you learn, the more empowered you will be to make the better decisions for you and your family and see if IBC is a great fit. So Bruce, thank you so much for sharing all your wisdom and always love your stories. I think they really help to really solidify and crystallize some of these concepts that, to your point, when you really look at them, they're not super complicated. And we're trying to do that. And Bruce does such a great job. That's why I wanted to have him come on, because he simplifies these things so that at least you're informed, and then you can make the best decision for yourselves and your families. So thanks for joining us on this webinar, and we'll catch you on the next one. Thank you.
Great job.
Yeah, that's great.